Formulating corporate-level strategy. Three approaches to understanding corporate-level strategy are portfolio strategy, the Boston Consulting Group, BCG matrix, and diversification. Portfolio strategy. Individual investors often wish to diversify in an investment portfolio with some high-risk stocks, some low-risk stocks, some growth stocks, and perhaps a few income bonds. In much the same way, corporations like to have a balanced mix of business divisions called strategic business units, SbUs. An SbU has a unique business mission, product line, competitors, and markets relative to other SbUs in the corporation. Executives in charge of the entire corporation generally define an overall strategy and then bring together a portfolio of SbUs to carry it out. Managers don't like to become too dependent on one business. Portfolio strategy pertains to the mix of business units and product lines that fit together in a logical way to provide synergy and competitive advantage for the corporation. The BCG matrix. One coherent way to think about portfolio strategy is the BCG matrix. The BCG matrix, named for the Boston Consulting Group which developed it, is illustrated in Exhibit 8.5. The BCG matrix organizes businesses along two dimensions, business growth rate and market share. 38 business growth rate pertains to how rapidly the entire industry is increasing. Market share defines whether a business unit has a larger or smaller share than competitors. The combinations of high and low market share and high and low business growth provide four categories for a corporate portfolio. The star has a large market share in a rapidly growing industry. It is important because it has additional growth potential, and profits should be plowed into this business as investment for future growth and profits. The star is visible and attractive and will generate profits and a positive cash flow even as the industry matures and market growth slows. The cash cow exists in a mature, slow-growth industry, but is a dominant business in the industry with a large market share. Because heavy investments in advertising and plant expansion are no longer required, the corporation earns a positive cash flow. It can milk the cash cow to invest in other, riskier businesses. The question mark exists in a new, rapidly growing industry, but has only a small market share. The question mark business is risky. It could become a star, or it could fail. The corporation can invest the cash earned from cash cows in question marks with the goal of nurturing them into future stars. The dog is a poor performer. It has only a small share of a slow-growth market. The dog provides little profit for the corporation and may be targeted for divestment or liquidation if turnaround is not possible. The circles in Exhibit 8.5 represent the business portfolio for a hypothetical corporation. Circle size represents the relative size of each business in the company's portfolio. Most large organizations, such as IBM, have businesses in more than one quadrant, thereby representing different market shares and growth rates. Diversification strategy. The strategy of moving into new lines of business, as United Health Group did by purchasing medical groups, or as search leader Google did by purchasing YouTube, is called diversification. Other examples of diversification include Amazon's move into consumer electronics with the Kindle electronic reader, Nestlé's entry into the pet food business with the purchase of Ralston Foods, and Microsoft's recent entry into the mobile phone business with the purchase of Nokia's handset and services units. Microsoft managers believe that having a handset business in-house will enable them to innovate and move more quickly in the rapidly evolving industry. The purpose of diversification is to expand the firm's business operations to produce new kinds of valuable products and services. When the new business is related to the company's existing business activities, the organization is implementing a strategy of related diversification. For example, United Health's move into medical services and Nestlé's move into pet foods are linked to these firms' existing healthcare and nutrition businesses. Unrelated diversification occurs when an organization expands into a totally new line of business, such as General Electric, GE, entering the media industry, or food company Sara Lee Corporation moving into the intimate apparel business. With unrelated diversification, the company's lines of business aren't logically associated with one another. Therefore, it can be difficult to make the strategy successful. Most companies are giving up on unrelated diversification strategies, selling off unrelated businesses to focus on core areas. For example, Sara Lee sold the intimate apparel business in 2006. It has since sold or spun off many of its units and been renamed Hilscher Brands. A firm's managers may also pursue diversification opportunities to create